Hi, welcome to the third episode of Budget Analysis series. My name is Swapnil. We discussed that there are direct taxes, indirect taxes, non tax revenue, borrowings, and disinvestments. These are five basic components of government's total cash inflow. But there is slight difference between the nature of these items. There is something called as revenue receipts and something called as capital receipts. Revenue receipts include tax and non-tax income, but capital receipts include borrowings and disinvestments. You can think of them in the same way like your own income. You might be getting salary or professional fees or interest on deposits, which is a part of your regular income or revenue receipts. But would you say that money received by taking a housing loan is your income? No. It is definitely adding to your cash flow, but it is not your income. You have to repay it back. Similar is the case with the government. So, even if more than 30% of government's receipts come from loans, it cannot be termed as their income. We have to repay it back. Disinvestments are a part of capital receipts because the government is selling its asset. Again, you can think of it as selling your own house or jewelry or equity shares. The sale proceeds on selling that asset is not your regular income. Also, the way it gets taxed is different. Profit earned on sale of any asset is called as capital gains. So, there's your hint. Therefore, disinvestment is also a capital receipt. Since its nature is not like a loan, it is a part of non debt capital receipts. There is a peculiar point about disinvestment. Again, let us take your own personal example. Sometimes you might be in a health emergency, sometimes it could be for purchasing another house, or it could be for sending your kid abroad for education. So, the purpose of using those funds can also be different for government. It can be used for paying salaries of government employees or even can be used for building roads and dams. When the government calculates its fiscal balance, which is income minus expenditure, it includes non debt capital receipts, which includes disinvestments. When its expenditure is more than income, then it is called as fiscal deficit. When the government is in deficit, it does not have enough money to spend and therefore it has to borrow money so that it can spend on public welfare. Therefore, while calculating government's total revenue, we include net tax revenue, non tax revenue, and non debt capital receipts. You can see such calculation in the budget at glance document, which we discussed in the earlier episode. That's it for now. Follow me for more updates on budget. Thank you.